Hi there, and welcome to this week's edition of Wealthy and Wise. Well, most investors spend their time asking one question: what should I buy? But Charlie Munger, of course of Berkshire Hathaway fame, said that there was a better question. Essentially, what should I avoid? So this week on Wealthy and Wise, we're exploring one of the most powerful ideas in investing: invert. Always invert. Sometimes the best way to build wealth isn't finding more winners, it's avoiding the mistakes that destroy it. So that is where we're taking this episode. Let's add some value. So I'm told great investors don't just look for opportunities, they spend just as much time identifying risks. In this segment, we'll explore Charlie Munger's famous mental model of inversion and why asking the opposite question can often lead to better investment decisions. Joining me, Howard Coleman from Team Invest and Mark Humphrey-Jenner, who's joining us from the University of New South Wales. Gentlemen, welcome. Mark, welcome back to the program. Maybe I'll just start with you, Howard.
Sure.
What do you think Charlie Munger meant by invert, always invert?
Well, I think there are really two parts to it. Most people get excited about what should I buy? What's going to make me money? And he was saying it's easy to get carried away with all the opportunities in something, but what could go wrong? What could cause that investment to in fact lose you money instead of making you money? And that's what he means by invert. The second thing, of course, is that for every company on the stock exchange that is likely to make you money, there are several others that never make a profit and almost certainly will lose you money. So if you're focusing on what could go wrong, you're much more likely to avoid all those losers out there that mean average returns are generally on stock market 7 to 10%. You can do a lot better than that if you can simply avoid all the losers.
So Mark, maybe I'll ask you, are humans just naturally sort of bad at this? We tend to focus on what we want instead of what could go wrong?
Yes, naturally, it is more difficult to focus on those other aspects. So another way of thinking about them is they're often the second order effects of what the investment involves. So for example, people might focus on how do I make more money, but they don't necessarily focus on how do I not lose money. Or for example, say they're trying to generate a portfolio. They're looking at mean variance portfolio optimization, to use just one example. They're looking at, well, how do I get the best stocks into my portfolio optimization? But they don't necessarily stop to ask, why is it that my portfolio optimization is simply not going to work? Which, for example, is why you get the juxtaposition between mean variance portfolio optimization and minimum variance portfolio optimization, which tackles the idea that maybe it's because it's very difficult to measure expected returns. So you focus on something you can measure, being the variance. And that's just one of many examples. You can see it, for example, in how people are doing budgeting. Instead of asking, well, how do I avoid losing money? They just focus on how do I make more money? But often avoiding losing money, whether it be your budget or be the federal budget, is often at least as important, if not potentially more important, than just that first order question.
Yeah, Howard, because I think to Mark's point about those questions that you must ask, investors want to know what makes stocks a winner. But how would a value investor, how would you, or a good investor, you could say, approach that differently?
Well, to start with, you approach it the same, because the first thing you do is you say, excluding all the obvious losers. So I can chuck out 800 companies on the ASX out of about the 1900 that are there, because they never ever have made a profit. Of the remaining ones, how many of them have too much debt? Okay, I can chuck them out as well. So you can do a few eliminations, and you then land up with probably too many companies for your portfolio. Now you want to look at those in depth. But see, as you boiled it down to a relatively small number, you can look at them in depth. You can't look at 2,000 companies in depth, but you can look at 40 companies, for example, in depth. And when you look at those, you already know that they are not obvious losers. So it's no point focusing on how big a winner will it be. It's going to be a winner. What you've got to decide is what could go wrong that could stop it being a winner. So a company that looks absolutely fabulous, what are the risks? what are the things that could go wrong in this business or with this management team or in society or in the economy that could cause this to be a poor investment, even though on the surface, in first order thinking, it looks like it's guaranteed winner. And that's really what Charlie Munger was talking about. He was saying, Warren and I get sundry proposals all the time. We look at them, we eliminate all the obvious ones we should eliminate, and then we're left with several that, rather than saying what could be wonderful about them, say, despite the fact that we think they're wonderful, what could go wrong? And we spend quite a lot of time in Team Invest meetings talking about the risks. What are the main risks? And we score the risks for likelihood of happening. So some risks are more likely to happen than others in the next 10 years or so. And how much damage they would do if they happened. Because sometimes you get a risk that's very likely to happen, but it doesn't do very much damage, so that's not that big a worry. Other risks may be very unlikely, but could destroy the entire business if it happens. So we've got a system of weighting and scoring that in order to get a better understanding of how much damage that could cause. And often with terrific companies that on the surface look great.
Yeah, but one of the hardest things I think for investors is really to admit when they're wrong.
Yep.
So Mark, how does inversion help sort of remove some of the emotion, potentially some of the confirmation bias even from investing?
It's often a little bit easier said than done, and also easier for people who have lasted through many different market cycles, because nothing disciplines the mind like losing a lot of your own money, which could happen during a financial crisis or a Greek debt crisis, which was a particularly painful situation for myself, for example. So you start to look out for what could go wrong and then focusing on what is it about your investment technique that is causing that. So for example, have you been focusing too recently on what has gone wrong, what has gone right, and where you've been able to successfully predict, for example, foreign exchange movements? But then you get potentially overconfident. So it's a matter of trading yourself to identify where you might be making an error and then taking a step back and trying to avoid that error. Now, it often comes with practice. Professional investors or experienced investors who have invested across many cycles will be naturally a little bit better at this just because they've already observed personally what goes wrong. The people who will have more difficulty, of course, are those who have not observed the cycles and or those who have not personally felt the problems associated with them, thereby not quite having the same salience. That lesson won't be quite as in-depth or impactful as it might otherwise be.
Yeah, well, Mark, I think you've raised an interesting point, because is inversion particularly important today, perhaps when you've got a lot of this enthusiasm around AI, a lot of these blockbuster IPOs coming to market overseas, technology and disruption?
Absolutely. And I'll give you another recent example to show exactly how this goes wrong. We all remember I'll call it the startup bubble that occurred during COVID, where there were a lot of very high valuations, a lot of companies that, particularly startups, that could effectively select their investors, and they could go to investor meetings and impose pressure on their investors to invest now. An example of that is FTX. And we know how FTX went. It imploded and was a disaster, in large part because many people didn't quite observe. Maybe they didn't do the due diligence, or maybe it was covered up and they needed to dig a lot deeper. But regardless, there are a lot of governance failures. So in periods of exuberance, often you get a lot of that just not being emphasized. Now, focusing on AI, still because of what happened with that wreck recently, the startup wreck that occurred during COVID, that's still fresh in the mind of some people, and they can still see what went wrong with NFTs and the like. And it's still applying some of that to AI. So it's important to apply the learnings, be skeptical, but not necessarily infer that everything is a hype-driven bubble, because there are parts of AI that will make genuine money, or there are parts of AI that are perhaps riding on loss-making businesses at the moment, and one needs to ask how they become profitable. So it's a matter of disentangling the positive and the negative as well.
Yeah, so it kind of goes to a Buffettism. I'm the one that's going to be quoting Buffett this time for the first time, saying you don't need to do extraordinary things to get extraordinary results. You need to avoid big mistakes.
Absolutely.
And so do you get the feeling that, to Mark's point, in this very hyped environment around AI, that it's even more important to think about what could go wrong?
Absolutely, because we're being bombarded with things that would cause us to be over-optimistic. I mean, one example is an IPO. Now, everybody looks at IPOs, whatever it's for, and says, wow, what an opportunity. I get in on the ground floor. What they don't realize is, why is the company at the moment going for an IPO? And why is it putting together a marketing document to persuade you to part with your money and give it to them? Now, if you look at all IPOs in that lens and you say, every IPO is really a marketing document trying to persuade me to part with my money and give it to this company, then you start looking at it a lot more rationally. You don't say, oh, I'm getting on the ground floor. You say, what could go wrong if I invested in this company? What are all the things that could go wrong that could cause this to be a terrible investment rather than a good one? And nobody goes for an IPO saying, let's raise as little money as possible per share. They say, let's get as much money as possible per share. After all, that will give us a higher valuation. So if you look at an IPO as what could go wrong if I invest in it, it's a marketing document, you'll probably be a lot fussier on the ones that you invest in. And the same applies to anything that's not an IPO. If a share price has been rising regularly, most people get enthusiastic and say, I should buy it. But the whole reason it may be rising regularly is all the people who were smart about it bought it when it was cheap. It's now no longer that cheap. So you've got to say to yourself, is this actually a reasonable price that I'm buying it at? But I think the other important thing is, look inside each company that you're intending to invest in with an attempt to understand, how does its business model work? How does it actually make money? And at the moment, we've got, similarly to what we had in the late 1990s or the late 1920s, there have been several episodes in history, we, instead of saying, what could go wrong with these things, everybody says, oh, new technology, it's going to make lots of money. As Mark points out, there'll be one or two of them that will, but there'll be a hell of a lot of them that are going to do the exact opposite and destroy money.
Yes.
And, if you invest in a basket of AI companies, you're going to lose a hell of a lot of money. You've got to pick very carefully, the same as you do with anything else. Pick carefully what you buy and what you invest in.
Well, that's my last question for you, Mark Humphrey-Jenner from the University of New South Wales. We've been talking a lot about this in context of ASX-listed companies, but you've brought up, FTX, which obviously was crypto. We've got, many other asset classes obviously available to Australian investors. Does this sort of inversion, this thinking of what could go wrong, apply across asset classes in your view?
Oh, absolutely. I think it's the beauty of this saying, this aphorism, but also in reality, a lot of what Charlie Munger has said. And I guess I'd encourage people to check out Poor Charlie's Almanac, because it has a lot of these mental models. But focusing on invert, always invert, well, it applies across asset classes. So I mentioned portfolio management before. So say, for example, your job is as a portfolio manager and you're just looking at putting a big matrix of stocks together to determine what is optimal. Or then you have the question of what can go wrong with mean variance optimization. In particular, parameter estimation. That can be a massive problem. So you need to dig into how to solve that. Another example is even startups. So for example, I often invest in early stage companies so that you're looking at what could potentially go wrong and cause this startup to not be the unicorn that it says that it is. Because every pitch deck says that the company is going to be a unicorn. But the question is, what might stop it doing so? And there may be governance failings. It might be that they're miscalculating the total addressable market. It could be there might be regulatory issues on the horizon. For example, if it's an NDAS provider, that might be an example. Another situation is if you're a treasurer and you're trying to raise as much tax revenue as possible, you need to consider what might cause my measures to not raise revenue. Or alternatively, where might tax revenue decrease, or what could cause it to decrease, such as reducing investment or reducing on-flow fiscal spillover, such as stamp duty, or exacerbating a lock-in effect. Those types of things might cause your plan to go awry. So it applies across the board. It's just a matter of working out the specifics for exactly what you're investing in is what is relevant to your particular asset class.
Yeah, Howard, look, value investors are all often described as pessimists who are looking for problems. So how do you How do you balance that healthy skepticism, that work, because it is work that you've got to do, with still finding opportunities?
Yeah, and in fact, we always find that very amusing that we're regarded as pessimists. Because if you came to one of our Team Invest meetings and 100 people in the room or so, you'd probably find that not a single one of them would regard themselves as being a pessimist. They would say if we were pessimists, we'd keep our money in the bank. We don't keep our money in the bank because we're optimistically aiming to get 15 to 20% per year on our investments. However, what we do realize is that if we allow our optimism to blind us to rational thinking, we're going to lose a lot of money. So we look at the moats of the company, in other words, what protects it and enables it to be a successful investment, as well as what are the risks. And because it's a big group of people, whenever we talk about a company, if there is somebody who's overly optimistic, for example, if I get carried away about some company and all the things that are great about it, there are bound to be a half a dozen people or more in the room who are going to say, but Howard, what about if so-and-so happens? Now, if you said to them at the time, you're being a pessimist, they'd say, no, I'm not. I'm just pointing out there's a potential risk over there.
Yeah.
We ought to take that into account.
All right. Look, Mark Humphrey-Jenner, University of New South Wales, thank you as always for joining us. Really appreciate your insights.
Thanks so much. Great being with you.
Take care.
Thanks a lot. Bye.
And Howard Coleman will be sticking around after the break. We'll take this inversion and we'll apply it to some specific stocks in head-to-head. So theory is one thing, putting it into practice is another. So rather than asking why we should buy these businesses, let's flip the question, what could stop us from buying them? Sometimes that's the quickest way to understand whether a company deserves a place in your portfolio. I'm here with Howard Coleman from Team Invest. Howard, welcome back. So we were going to put a few companies under the microscope, and I think we're starting with a company that many of us know, many of us love what they're doing, at least, Cochlear.
Absolutely. I mean, a wonderful Australian success story. Brilliant science, brilliant medical science, incredibly bright people working there. And not only did they develop this method of helping deaf people here, but they've developed it better and better and better. In fact, funnily enough, yesterday I was at a Team Invest meeting in Melbourne, and one of our members there has a cochlear implant. Maybe more than one does, but anyway, one I know of it that does have a cochlear implant. He showed us his latest one, which is like attached to the side of his head. He pulled it off and said, look, there's my cochlear. And then he put it back on again, and he said, it's so much better than having to have it put inside me. Now, I presume he's originally got the original one inside, but this is the latest thing. And he was raving about how much better the sound quality is than the one he had before and how adjustable it is. Anyway, so marvelous business and run by very bright people, except the problem is one of the most important things any board and management team has to be good at is something that is usually overlooked when recruiting either board members or managers.
Which is?
Capital allocation. If you're not good at allocating capital and you're running a business, there are always competing needs for your capital, all sorts of different reasons. Should we spend it here? Should we spend it there? Should we spend it there? Should we make an acquisition? Should we return it to shareholders? Should we spend more on marketing? All of those things compete with one another. And as Warren Buffett, seeing as we've been quoting him, said when asked a number of times in the last 15 years or so, what's his succession plan? He said, one thing you can absolutely be sure, he's said this in many different words over time, whoever is appointed after me will be somebody we've chosen because of their terrific skill in capital management, because managing the capital of the business is the most important thing. Now, Cochlear, as clever as all their people are, I mean, Newton, Isaac Newton, the famous scientist, is supposed to have said that he can predict the movement of the stars in the heavens and the planets in the heavens, but he can't predict the direction of markets. Now, why he said that is he'd just gone broke on a whole bunch of investments in a bubble that happened at the time. And Cochlear's demonstrated very, very poor capital allocation.
So you are saying that if you would have looked at Cochlear from an investing point of view and said, what could go wrong? Capital allocation would have been...
Yeah. Now, you maybe wouldn't have noticed that years ago, but in the last couple of years, they proved to be extraordinarily poor capital allocators. And even when it was pointed out to them, they couldn't see the nonsense of their position. So they issued shares during the COVID crisis, and you could understand they wanted to raise some extra money because they couldn't do their operations and they had expenses. And they raised capital at $85 a share. I bought some. I already own Cochlear shares. I'm sure most of our Team Invest members added to their holdings. More recently, they decided they don't need all the capital they've currently got. They'll buy shares back on the market. And when did they buy shares back on the market? At prices between $260 and $308. That's nuts. If they'd only looked at something like the 10-year history, as we look at always, of companies, they would have said our PE ratio is near its highest it's ever been. We don't want to be buying our shares now. Sure, we may want to conduct a buyback to return some money to shareholders, but let's wait until the share price drops for some reason. Now the share price has dropped and had got down to below 100. I forget the exact figure, but it got below 100. It's a bit over 100 now. They're not buying back shares now.
Okay.
They bought them back at between $260 and $308. And at their AGM, when they were buying them back at those ridiculously high prices, several people raised with the chair at that AGM that this was poor capital allocation, and shouldn't they have somebody on the board who knows and understands investing in capital allocation? And the chair said, oh, everybody on our board knows about capital allocation. Well, that's a case of a little knowledge is a dangerous thing.
Right. All right. Just in the interest of time, there's another company I would like to discuss, and that is ProMedicus. So if I said invert, always invert when it comes to ProMedicus, what would I have been finding the potential to go wrong, the risk?
Okay. If you look at ProMedicus, absolutely wonderful company, very well run, terrific management. They bought this product, Visage. They've developed it further, and they're marketing it to hospital groups around the world and doing really well. And the earnings per share going up at an incredibly rapid rate. Now, first order thinking says, oh, the earnings are going up at an incredibly rapid rate. They'll keep going up forever. Nothing ever goes up at a very rapid rate forever. The second thing is its share price got to a point that it was on a PE ratio of over 300, and the share price got to $300 and something. There was nothing wrong with the business. It's just there was something wrong with the share price. If you looked at that business, you said, terrific business, I'd like to own it. When would I like to own it? Well, gee, when I can buy it at a price that's quite rational. If you go down to go buy a new car, and let's say you're looking at a Volvo, and I saw an advert for one on the way in here, that's why I know the price, and it says from $55,900. And you walk into the Volvo showroom and they say, oh, no, that was last week. If you want a Volvo now, it's $159,000. You'd say, no, thanks, I don't want a Volvo. I'll come back when they're at a reasonable price again. But people don't do that in the stock market. They assume if the price has gone up, the company's worth more. No, the market cap may be more. The actual business is the same business it was if the price was lower. Whether PME shares are currently at $100 or $200, it is exactly the same business generating the same profits with the same growth in earnings per share. Surely you'd rather buy it when it's at 100 than when it's at 200.
So the risk was that the price to earnings ratio was just way too high and it's going to come back down to earth.
And it did. It came down from 300 to 120 or something. And at 120, it was probably quite reasonable. So you may have wanted to buy some now. Now it's back up to nearly 200 again. You probably look at it as a value investor and say, wonderful company, I'll keep it on my watch list. I need some bad news so that the share price drops and I'll buy it then.
Okay, invert, always invert as it applies to QBE. If you had flipped the question, what would have come to the fore?
Well, insurance companies, as Buffett knows well because they own a lot of them, insurance companies, if they are very well run, are hugely profitable businesses, not because they charge much more for the insurance than they pay out. In fact, the payout ratio for most insurance companies is close to 100% of the premiums. They really make very slim margins on the actual insuring that they do. However, they get all this float. You take out a life policy, I take out a life policy, for instance, or a car policy. We pay the money up front and we insure it for a period of time. Now, all that money, if they are good capital allocators, which Berkshire Hathaway are, they invest that money and earn an enormous amount of return on that money. That's where their profit comes from. Now, QBE has the disadvantage that they haven't been particularly good capital allocators. They've made some very poor acquisitions over the years, and their profit margins, like all insurance companies, are slim. Why insurance companies' profit margins slim? Because if you or I get our new renewal in the post, or by email nowadays, and it says our premium's gone up 20%, we say, I'm not going to pay that. We get on the phone or on the internet and we find somewhere that's cheaper. So like any business that's very competitive, it makes very slim margins. So you've got to look beneath the hood with an insurance company. You can't just say, Berkshire makes lots of money out of insurance, therefore QBE will make money out of insurance. No, Berkshire makes money out of insurance, not because they're good at insurance, they are, but they're also good at capital allocation. QBE is good at insurance, but it's not good at capital allocation.
Okay, so one more, because this is kind of fun. NEXTDC. So if I approach this as an investor, I'm thinking data centers, I'm thinking, property, all the sort of attributes that NEXTDC has. What if I inverted my thinking, would it come to the fore?
Well, the first thing you do is you say, new technology. Everybody gets excited about it and everybody's going to get rich. Hang on, if I read a few history books, I'll discover it didn't work like that. Almost all the times in history where there was a new technology, it looked like everybody was going to get rich. Society benefited in the long term, but the people who put their money in usually didn't do terribly well. So you look at data centers. What's the moat that a data center has? What stops them having a competitive data center? Nothing. You can build data centers all around the world. The advantage too is you build them all around the world and the information goes via the internet, so it doesn't even have to be close to the customer. Yeah, it helps if it's close to the customer, but you can build them anywhere. All you need is land, buildings, and the stuff that goes in them. And the stuff that goes in them, and I'm deliberately using vernacular here, but the stuff that goes in them gets faster, cheaper, and smaller every year. So you build this big data center, you put in these hugely expensive NVIDIA or whatever chips and things into the data center, and a year later NVIDIA comes up with one that's much better, far improved on the one that you've already spent tons of money on putting in the center, takes up half the space, so you could now get twice of them into your data center, twice as much of them, but you've already spent the money. So you're spending all this capital intensity in building something that is going to be antiquated just after you've built it. It's the same as we've discovered. I mean, you and I are carrying in our handbags or pockets a computer that is considerably more powerful than the giant thing I had in a big, for my business in the late 1970s that filled a room twice as big as the studio. Now, I've got much more than that in my pocket. So when you look at NEXTDC, you say they're spending a huge amount of money building something which is antiquated straight after it's built. They're putting in stuff inside it that's going to shrink in size and get better, but they won't have recovered all the money that they spent on it yet. And there's no way of stopping competitors doing exactly the same thing. I mean, we own part of a business called Multimedia Technology. We own in Tip Group. And it supplies NVIDIA chips. It's one of two companies in Australia that has the rights to do that. And if anybody phoned them up or sent them an email and said, I want to buy some of your chips, they don't say, no, we won't supply you because we supplied some other data center already and you, their competitor. They say, great, we got another customer.
So if you had invert the thinking around NEXTDC away from the hype around data centers, some of this would become obvious to a value investor.
Particularly if they looked at the history of NEXTDC, which is that it's hardly ever made a profit. It makes loss after loss after loss, year after year. It is always promising and raises a lot of money from shareholders.
So what we will say then, perhaps just to wrap, is that not pessimists, just healthy skepticism.
Yes, absolutely. And remember, the company will always tell you reasons why they're a great buy. They won't tell you why there's a problem. They'll tell you why they're a great buy.
Yeah.
So you've got to be a bit of a skeptic in order to avoid being sucked in by that.
All right. Well, listen, I think that's where we'll end it today. We did have a viewer question, but it was on ProMedicus, and I think we answered the viewer question within your answers. So, Howard Coleman, Team Invest, a pleasure as always. Thank you so much for joining us.
A pleasure.
And thank you for watching Wealthy and Wise. We'll see you next week.
Thank you for joining us on this episode of Team Invest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Team Invest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.